How we doing? Today is Tuesday, January the 23rd, 2023. We're live on Instagram as well as here on Zoom. On Tuesdays and Thursdays, what we do is we talk about real estate notes and becoming the bank. On Thursdays, we'll focus more on actual deals that are out there. On Tuesdays, what we'll do is look at real estate notes and becoming the bank, creative finance, seller finance. And we'll look at the topic as a whole and kind of just break it down into small bits and take you through the process. If you go to the YouTube channel, Abundant Capital Group, I've done this before. There's a series there of videos, but we want to continue to get this information out there. Really because of the time that we're in right now, that we're the date that we're recording this. There's a lot of things going on in the market. Supply is down, demand, has kind of tapered off, but there is, demand out there. People do want to become homeowners. Banks are restricting credit, offering loans to people is becoming harder because of the commercial real estate market that we're in right now. So we have a lot of different factors going on right now um, that will lend itself or be a good opportunity to learn notes, understand notes, invest in notes, um, and become the bank. You'll hear the term around this time that they're trying to make us a nation of renters. A lot of institutional money, Wall Street money, big hedge fund money came into real estate back in 2007, 2008 with that crash. Also, a lot has been in the market, during the pandemic and things like that. And they're buying these properties. They're able to buy thousands of properties at a time because of the amount of money that they have and then offer them for rent. But we, as smaller investors, we have the ability to be able to create financing for someone to be a homeowner. And we're going to kind of go through why you want to do that, the different aspects of it. We'll, touch on different things week by week, but today is the first installment of it. And so, what is a note? A note is a note goes, it's an IOU, it's a promissory note. It spells out, the terms of the loan that you're creating or giving someone and how it's going to be paid back. It's an IOU. And the note goes along with some form of a security agreement. Here in New Jersey, where I am, we use a mortgage. Other places, they use a deed of trust, the trust deed, as the security agreement. It may be called some other things in some other areas. There's a lot of different names for it, but primarily you'll hear mortgage, deed of trust, trust deed, and you'll hear those terms, and they go together. Um, the note, like I said, spells is the IOU. It spells out how this thing is going to get repaid, what interest rate, how many months, and the security agreement attaches the property to that IOU. So if you don't do X, we have the ability to do Y. And that security agreement gives you the right to then be able to get that property back because of the loan that you created or the financing that you created, and that person wasn't, able to fulfill. It gives you some type of recourse, something that you can get if that doesn't happen. And that's really one of the biggest reasons for me, the biggest reason why you want to be the bank as opposed to maybe some other strategies within real estate, because you can always get the property back. You may not get the money that you wanted and the amount of months that you were looking for. Maybe you were looking to get paid off in 3 years, 5 years, something like that. Um, but it's very hard to lose when you actually get that asset back. And then you can then go ahead and do something with that particular asset once you've gotten it back through a foreclosure at worst, or a lot of times people get into trouble. A lot of times they will deed the property back to you if that needs to happen based on the security agreement. But you can get the property back, and then maybe you take it and you go and you do a couple of other exit strategies, maybe, just depending on what the situation is at the time. There's a number of exit strategies that you can use if this particular homeowner got into trouble and couldn't repay. And so that's really like the biggest reason um, that people really should look into note investing and understand what notes are, no matter if you're a fix and flipper already or if you have rental property. And that's fine if that works for you. That's great. Those are excellent strategies, and you can continue to do that. But what I would say is that you want to understand this part of it to go along with maybe what you're doing already. Maybe at a different point in your life, you don't want to do the whole landlording thing. And then you can, come over to notes. Maybe you don't want to do as many fix and flips on a yearly basis that you once did. You're transitioning. You can look at becoming the bank when you fix the property up and things of that nature. So, um, so that's the note and the security agreement go together. They go together. One is recorded, the security agreement is recorded, the note is not recorded. So another reason why we like notes is because it has low risk with a high yield. A lot of times we're able to get, double-digit returns on these particular deals with low risk. And the reason why it has low risk is because we buy notes at a discount when you're purchasing notes. Now you can create a note, and when you create a note, when you do that for someone, that means that that particular person can't go down to their financial institution, get a loan, and be able to purchase a house for whatever reason. It's not always because somebody has bad credit, they, had something, terrible show up on their credit or whatever the case may be. It's usually, sometimes it's not, that type of reason. Sometimes it's, they're self-employed, how they make money, and things of that nature. Maybe they're not a citizen just yet, and the banks have some issues with that. So there are a number of issues, especially in the environment that we're in today when this is recorded, that if you don't dot every I and cross every T, a bank or lending institution, won't qualify you. And again, there's a lot of people that fit that category. There's a lot of people out there that are working, have good jobs, make certain amount of income. Because obviously you see at this during time, rents have gone up. So people are paying, some really expensive rent to live somewhere. So a lot of people can afford to be homeowners, but they're just not presented this opportunity. And that's what we're looking to create, more people who can create these opportunities and not make this country into a country of renters, build homeowners who can build equity and build wealth for their families. That's what we want to do. So, like I was saying, back to the high yield with low risk. The reason why when you're purchasing a note, we always purchase them at a discount. And then when we create notes, we're creating them at an interest rate that is above whatever it is standard for the market. So right now, I think today I got to like 6.8 or 6.9, somewhere in that range. Um, and that's not the APR rate. The APR rate is probably 7.5, something like that. 7.3, 7.5, somewhere in that range. So we can actually go higher than that because we are offering something like, again, that they can't go down, they can't go to Wells Fargo, Bank of America, any lending institution to get qualified. So our interest rates a lot of times are 9.5, 10.5, possibly 11%. But it all comes down to affordability. And that's the key. You want to be in areas that, that people can afford, and live in the house, make sure they have the income, make sure that they're making the amount of money they need to make to be able to sustain this property. Because people really aren't, a lot of people aren't really interested in the interest rate. They just want to know about that payment, especially when they've gone down to lending institutions, got denied, maybe more than once. You have a family, you're starting a family, and you want to own a home. So they're going to look at, well, what is that payment going to be? And as long as that payment can fit their budget, where they can sustain it, you will you can write it at any type of interest rate that you want. I shouldn't say any because, there are usury laws and you can't, just gouge people, but usually somewhere between that nine, I would say to like 10 and a half, 11% is where a lot of these notes are written. And if it's written that way, that means that you're going to, make that interest each and every year, as long as the person keeps paying. On one end, like I said, you can lower your risk because you buy on a discount. When we purchase notes, we look at what the value of the collateral is. So just to take round numbers, if the value of the collateral is $100,000, that's what that property costs, and there's a note on it, we're probably not going to pay more than about 70,000 if that's the unpaid. And it depends too on what the unpaid balance is and things of that nature as well. But just to give you an idea, we're usually around like 72% of the value because that protects us in case, worst case scenario, something goes wrong and I have to take this property back. I know I have about 30, percent equity in this property that I can then, if need be, I can go and sell it and just retain, get back all of my money. But each time that somebody makes a payment each month, your risk is less and less and less. So when you're buying these, you're able to make sure that you are, not being too risky. Obviously, if you want to do more risky, and spend a little bit more money, I mean, that's just something that, your risk tolerance is for. But we don't recommend, somebody go over that 72% threshold when it comes to the value of the property. Now, when you set up these mortgages and different, the notes, you want to, look at too what, you want to understand what the unpaid balance is. Because like I said, each time you make a payment, that unpaid balance gets less and less and less. It goes down, it's amortized. It's amortized over a certain amount of time. So, you may pay a higher percentage of the unpaid balance, depending on what it is. But in relation to what the value of the property is, you want to protect yourself and be somewhere at a maximum, I think around 75%. So, that's how we protect ourselves in case something goes wrong. And, we look into the file, we look at the borrower, we look at their qualification, we look at a lot of different things, which we'll get into, down the line. But just for today, I just want people to understand the concept on why we do it. What do you buy that you invest in that you buy at a discount? I don't know what people are investing in and their strategies and things of that nature, but at least with this, you have that safety net of buying at a discount, as well as when you write these notes or create them, you create them at a very good return. People today would love to get 7, 8, 9% return on their money consistently. That is also backed by a tangible asset. So those are really good return numbers. On a yearly basis, your ROI, if you're getting 9, 10% or more, people are going to be extremely happy with that. So again, these are just some of the, preliminary reasons and some of the basic information about real estate notes that we want to share, today and moving forward. So those are a couple of reasons why we like the notes. Let me see if I have another one here. Another thing, with when you create the financing, the person that's in the property is their home. So do you think you get a better person? Well, I shouldn't say person like who the person is, but when a person is living in the home and they know that they're a homeowner as opposed to a renter, which one do you, put more faith in is going to continue to make that payment, do the right thing, buy the property? Most likely a homeowner because they're living there with their family. A tenant, can, do certain things to an apartment, to a rental unit or whatever. If they get disgruntled, something happens, they have a friend over, whatever the case may be. But when this person who owns this property, is living there, they tend to take care of it better. They tend to improve the property. That's something that happens too. If you get a certain, if you buy or you create a note on a property, the person may get the roof replaced, may put new windows in, may do the floors, may put carpet in there, may do some type of enhancement to your property over the time that they're living in. I mean, people know, if you live in a house, how many times, I'm pretty sure you've done some work on your house. That only improves the value a lot of times for the note holder. So if they improve the value of it, now your risk continues to go down. So that's a great thing. But you get a better quality, not just, not personal quality, but a better person in a property when it comes to a owner versus a renter. So that's another thing. Also, we don't have any maintenance responsibilities. We do not have to cut the grass. We don't have to replace a window. Something happens with the roof, something happens with the furnace. That is not the note holder's responsibility, or the person that creates the note. It's not their responsibility. That person who's living in that property, that is on you. When something goes wrong in your home, do you call Bank of America? Do you call Chase? Do you call Wells Fargo? No, you don't. You call a plumber, you call an electrician, you call a handyman, or you fix it yourself in that instance. So right then and there, those costs. And again, those are costs a lot of times that you don't have to incur, as opposed to if you had a rental property. You get those calls sometimes 12 o'clock at night in the winter that something went wrong, something's not happening. Oh, I need to get this fixed. And if you don't fix it, then I won't make my payment on the first of the month type of situations. So these are things that you eliminate when you create a note or you buy a note, because you're not the person physically living in the property, you're the bank. Again, we have to put ourselves in the mindset of a bank. What does a bank do? Bank just basically collects payments. If there's something that goes wrong down the line, they reach out to you and try to rectify it. If we can't, then what do? They go after the property. And it's the same thing, if you invest in these or you create these on, maybe you have some type of rental property portfolio already. Maybe you want to do an analysis, look at, if I was to create a note on this and become the bank, what are my numbers looking like as opposed to this rental? You could do that as well. So again, we just want to take, some time each and every Tuesday. We'll kind of go through more of breaking down what notes are, and then Thursdays we'll look at deals. But we just want to kind of take this bit by bit, piece by piece. I don't know if a lot of people, know about this, have heard of this before, but with everything that's going on, you are going to want to look into this opportunity, especially how things may pan out through 2024 going into 2025. It's a political year and things of that nature. They're showing some cracks and things like that in the economy. A lot of layoffs and things like that are going on. And there may be an opportunity where, if you understand notes, you can help a lot of homeowners. Now, we'll get into the different types of loans that you can buy, but um, my main thing is to try to get people to understand the concept, and why right now is the time that you want to take advantage of this opportunity, especially if you're someone who has been working at a job, has some type of retirement account. If it's, in the stock market, wherever it is, you want to look at possibly pivoting and looking at other options just to diversify yourself, um, just to look at some other things in case, the stock market takes a hit. We have a downturn in the economy. You want to be able to look at these opportunities to help people, especially, when people start losing their homes and stuff like that. Who do they reach out to? They reach out to their lender to see if something something can be done. And that's where we can help people if the economy, starts to shift, take a downward turn, or whatever the case may be. You're in control as the bank. You don't own the property, but you control it. You have a controlling interest. And really just think that, in terms of a real estate opportunity, this is the time that you want to look into that. And if you are someone who has, significant amounts of money that you want to invest, the commercial space right now, when it comes to notes, has great opportunity. A lot of these multifamily um, and commercial type units are having debt issues. They can't refinance this debt in the interest environment that we're in right now. A lot of times they got those properties paying 3.5%, 4% for loans. And now that they're maturing and need to be refinanced, you can't get anything probably below at least double that. And that's causing, all the numbers on the property to be out of whack. And, even who is coming back to some of these commercial type units. After COVID, a lot of businesses unfortunately shut down. They're not coming back. Some of the big companies, they're doing the work from home type of thing. So there's a big opportunity over on the commercial space. There'll be commercial loans that can be purchased and possibly worked out, or you can get those properties back and then potentially sell them or do something, with them once you do get them back. So again, the biggest reason that we really want to get this out is because you're protected even if things go wrong with a note. You have multiple exit strategies. Like I said, we'll get into that a little bit later, but you have several exit strategies when you're the bank. Banks do not lose. If you look at it, banks do not lose. They're in the business of lending, especially when it comes to real estate, and they don't lose for a reason, because they can always get that property back and be able to do something with it. So, like I said, this is just the first one that we're doing. Hopefully, I gave you good insight, gave you something to pique your interest, something to think about. If you're watching the replay, please post any type of comments, or you can reach out to us. Our telephone number is 973-475-8488, or you can shoot us an email at investorgmr@yahoo.com. Leave a comment here, or a question. You can email or text or even call, and we'll get that answer for you. But each week we'll kind of just break this down a little bit further, but wanted to kind of give you that foundation on why you want to do notes and what a note is and how they work together with the security agreement. And hopefully you got that information, and then we'll take the next step next Tuesday, right about this time, 8:15 p.m. In the evenings. We won't go long, 20 to 30 minutes at most, just to break this up, bite-sized pieces. And hopefully people will, want to look into this opportunity, especially, like I said, if you have some type of retirement account, you can get those funds moved into another retirement account, a self-directed IRA, and then you can use that money to take advantage of some of these opportunities out here. So I hope everybody, piqued your interest and you want to possibly learn more and do more and take advantage of the opportunity that we're in. And hopefully we can work together. So have a good night, and we will see you back here next Tuesday at 8:15 p.m. Eastern Standard Time. Have a good one.